A Beginner's Guide to the Stock Market by Matthew R. Kratter. So this book is definitely a beginner's book into the stock market. It gives you a little bit of a basis about everything in the market. It first goes over what a stock is and how it's a share in a company, what a market cap is, and how it can determine a company's valuation, and that the market is a reflection of the news and a representation of where the market is going. He uses the example of a hockey player going to a puck quite frequently, explains that investors are people that buy and hold, and traders are people who day trade. It explains what a stock exchange is and how that's a place where people exchange stocks, how a ticker symbol represents a company and only a few short letters, and how a broker is basically the middleman between you and the stock market, and how they fill your orders for you, and goes to recommend Robinhood since they offer free trading. He explains what a market order is and how it fills your stock order at the price it is currently trading at. He explains what a bid is, what an ask is, and how a bid is the price that people are willing to pay for a stock, and an ask is what the current stockholders want to get for that stock, and the bid-ask spread being the difference in price between the two. He explains how a liquid stock is easy to buy and sell, and how you should always use a limit order for any type of purchase in stocks, and how there's different ways to place these orders, and how you can have an order for a good for the day or good till cancel. And if you're in the pre-market or aftermarket trading hours, you should always use a limit order no matter what, being that it's so volatile during those times. How an index fund is basically a basket of stocks, and how you can invest into it is investing into a bunch of different stocks. He explains that the Dow has 30 companies, and how the Nasdaq is comprised of tech stocks, and how indexing is a safe way to invest. He tells you how 50 to 70% of people actually do this, so it doesn't yield as much of a return as it did back in the day, but it's still a good safe way to invest even now. He explains what a dividend is and how companies that are very successful raise their dividend every single year. And one of the best ways to invest, he says, to actually invest like Warren Buffett, and the way you can do that is going to Berkshire Hathaway and either buying their stock or looking at all the stocks that he currently owns and just buying them, and how pricing power plays into effect when buying a stock. He likes stocks that are able to raise their price and you wouldn't even notice, versus stocks that if you were to raise their price for their goods that they are selling, it would actually greatly affect their company. He gives the example on how if Coca-Cola were to raise their price by 10 cents, you wouldn't even notice, but if a local gas station raised their price 10 cents, you would go to the competitor. He explains what value investing is and how it's buying stocks at a lower cost, and how bargain stocks are actually terrible buys. He shows the example of Netflix and Blockbuster, and how Blockbuster's PE ratio was only 2 while Netflix was 25. However, even though Netflix had a PE ratio of 25, they were the one to ultimately take over Blockbuster, and it was a great buy. Talks about how the PE ratio should generally be above 25, and if it's below 10, you want to stay away from that stock. He loves companies that are hitting new highs and with a market cap of $5 billion or less, since they still have room to grow, being that institutions will buy stocks only above $5 billion, and once you get to that point, it's really hard to have a price gap up. The stocks he's most interested in are the ones where their 50-day moving average is up and their 200 moving average is up as well, with their 50-day moving average above the 200 average. Talks about how the news will make these companies grow even higher, and how the people shorting these stocks, once they start to go up and they have to cover their losses, will make the stock go even higher, making these what he calls a rocket stock. And how there's a lot of IPOs at the end of a bull market, and to generally stay away from IPOs unless you're an experienced investor, explaining multiple reasons why an IPO can be bad, with examples of how insider trading, where people, once they go public, they decide to dump their shares off into retail investors like us, and how if they were private for too long, that a lot of the times their profitability has run out. Giving the example of how Amazon was only private for 5 years, and once they went public, they've skyrocketed since. However, with Lyft, they were private for 10 years, and once they went public, they have shot down dramatically. He then explains how covered calls are a great way to make money as well, especially on stocks that aren't really moving too much and you know that they won't move too much in the future. And then he gives you the 5 mistakes that all new investors make, and he tells you to never trade penny stocks, to never short stocks, to never buy stocks off other people's ideas, to never put your account on margin, and to never buy stocks that are just hitting 52-week lows. If a lot of people already know about the stock, it's usually too late to buy it. He then tells you how May through October is usually a bad time to own stocks, and how November through April is a great time to buy stocks. The bears make money, the bulls make money, but pigs get slaughtered. He then explains how everyone can be a stock trader as long as you put the time and effort into it. So I hope you guys liked the video. Remember to like, comment, subscribe for more future content. It really helps us out here. Thanks again.